So, understanding future contracts. Very regulated, very often used in the commercial space, future contracts. Very good products to trade. We will now go deeper into them. What are they? How do they work? What's the benefits? What's the pros and what's the cons? So, future contracts. What is the purpose of them? Mainly speculative, so people trying to earn money with them, speculating on an underlying asset or on the future contract of an underlying asset, or for companies, mainly purpose is hedging. So a future contract is the obligation to buy an underlying asset at a future date. As I already explained earlier in the course, if I'm a company that is in the shipping business, for example, we need a lot of oil because all the tankers going through the seas of the world need oil. And I don't want to buy every month the oil when I need it because sometimes maybe I pay $50 for a barrel of oil. Sometimes I pay more. And I want to calculate for the upcoming years because for companies, this is obviously very important. So it would be very nice if I can now decide for what's the price of oil now, and I can now buy a contract that guarantees me that I get amount X that I need of oil at every month. So there are future contracts in different products. In some products, you have future contract every month. In electricity, you have future contracts every couple of minutes or hours, and you have future contracts also for stocks sometimes, or for indices that are most of the times every 3 months. But I now can decide and now buy, for example, a future contract for every month of the upcoming year, and then I now buy the obligation to buy the underlying asset at a future date. I can also sell the future contracts, but for me calculating, I know that I need at least this amount of oil, for example, for my shipping company, that I can buy the minimum. So I have less risk in the markets. If oil prices double, I still know I have this price for this barrel of oil and I will get this oil at price point X in the future. This goes through centralized exchanges. That's the purpose of those. For companies, this also happens. For example, Starbucks needs a lot of coffee. You also have future coffee products. It's also in orange juice, it's in meat, it's in grains. So all the different topics, also oil, silver, gold, all those assets have future contracts, and that's the use case of those. Where are they traded? On centralized exchanges regulated. So future contracts also, for example, the CME Group, NYMEX, or the Eurex, which is in Europe. So all markets are traded at the same place. It's not decentralized like different liquidity providers and different stock exchanges. There are different stock exchanges, but there is a future on the stock exchange, and that is centralized service. So you have volume data. But these are the contracts you need in order to access order flow data, because you have a centralized place. So even the price does not change, stays on the same level. They can be still traded 500, 5,000, or even 5 million contracts. In CFDs, you would only have one kind of volume, when there's one tick. But order flow data shows you that even at the same price point, doesn't matter how long the market stayed there, how many contracts are traded. So there's not really a big conflict of interest with your broker, because your broker takes commission for the infrastructure they are providing, for the connection to the stock exchange, but you trade against the market, you don't trade against the broker. Your broker does not decide, are you A book or are you B book? Because they are regulated, you are always A book and you're executed on a real market. So you trade against the market and not against your broker. What are the pros of futures? You're regulated, it's transparent, you have volume data, real volume data, so you know what are the market participants doing and where are they trading. You have all the flow data available if you buy data feeds. You do not really have spreads, they are flexible. You have a tick, so you have a best selling price, best buying price, it's not at the same price. And you don't have any markups or that much dependence on your broker. Yes, there is a difference between brokers, but your execution is always on the stock exchange, which is centralized, so you just pay the bid-ask spread. So you have a spread, but it's not as flexible as with CFDs. And you have very high leverage on most brokers, because a future contract itself, you have different margin requirements depending on the broker, but the volume you trade of the underlying asset or the value of the future contracts is way higher than the margin you need, depending on the broker, depending on the asset, but you have very high leverage, which can be good, but for that you need to understand risk management, which is going to be Series 600 in this course. And your track records are accepted by most auditing firms. If in the future you're going to plan maybe to build your own fund, hedge fund, whatever certificate, people want a track record of you. And if you only have CFDs, because you can cheat a lot in CFDs, most auditing firms or companies don't accept this. If you have a futures track record, it can be verified because you have a statement of your broker. You can also request the trades from the stock exchange. You can match this up, and because it's a regulated product, people or auditing firms accept this. With CFDs, it's not always the case. But there are also some cons. You have a higher entry barrier because you need more margin. You cannot trade 0.001 lots. There are regular contracts and micro contracts, but still the entry barrier is way higher than with CFDs because the margins are higher in futures, but it's also depending on the asset you trade, on the broker you trade. You can research that on your broker's website, but they're definitely higher than with CFDs. With $10, you're not able to start trading futures. You need a data feed for a platform. You don't really need it. You can also trade without, but then your data is going to be delayed. I think on TradingView, the basic delay is 15 minutes. Also different on the exchanges you trade or also the future products, but you need to buy the data feed that the stock exchange is providing because there's one central place where the future is traded, and you need to buy the access to that data so you get it. So it's not as user-friendly as CFDs because most of the time CFDs are real-time and you don't need to buy data. In this case, because it's centralized, you need to buy data. And it's way harder to trade illiquid assets because there are some illiquid assets in there. For example, orange juice is way more illiquid than gold futures or oil futures, but we focus in this trading course also on the trading strategies on the most liquid ones. And there are no fractional contracts. So you can use micros, but so micro contracts that are smaller, you need less margin, the value of the contract is less, but for that the fees are higher. So the commissions you pay are higher. So you have a little bit more cost. For that you have more flexibility, but it's a con. CFDs, you don't have higher costs if you just trade fractional shares. And you don't have hedging. As I already explained earlier, when you are long one contract and then you want to hedge yourself, either you need to switch to micro contract or a future contract. For example, if I'm long in an oil contract in February and want to go short, I can choose the future contract of March or any other contract, but not the same contract. I cannot be long and short in February's oil contract at once. If I'm long one contract and I want to go short, I just sell my contract, which I'm long, and then I'm neutral again. In CFDs, it's different. You can just use another contract or micro contracts. For example, I can be long in an oil contract and just use the micro contracts to go short. That's possible. Then I'm long and short in futures or in the same future market, but there are different contracts. So, and new positions are automatically added. I already explained that. So when I open a position, and in CFDs I open another position, even if it's also long, I just have two open positions. In futures, it's going to be in the middle of both positions, depending on the size. If I buy one contract and then $10 higher, I buy another contract, I will have two contracts long, $5 in the middle. So it's just the average entry price. Also, when I'm scaling out of a position, it's the same process. Also the difference to CFDs. What orders do we have? We have also buy market called ask. We have sell market called bid. It's the same here. But the difference is you don't have the exact or an automatic stop loss like in CFDs, because you need to view this differently. It's not just you close your position. When you open the trade, you need to create a bracket order with the trade. So I buy one contract and then I need to add bracket order to that contract. Same is for selling a contract, but in the case I buy a contract, OCO order is one cancels another. In CFDs, you can just put a stop loss and take profit. Very easy to understand. An OCO order is kind of the same. The process behind it is just a little bit more complicated. So one order cancels another. When you have a stop loss and a take profit in the CFDs, they automatically get deleted when either stop loss or take profit is hit. Here we need to define this as an OCO order. So if one order is reached, the other one is cancelled. In CFDs, it's like the basic setting. But here on most future brokers, we need to do this ourselves. Let's go through an example when we are long one contract and we want to stop loss and take profit because we do risk management, of course. Then you will need to place a sell stop as a stop loss. So if price level is reached, then we want to sell immediately. And we will place a sell limit as a take profit. So above the entry we have, or we open the position, we want to sell at a specific price above. And then we combine those rules and connect them through an OCO. So when order is filled, the other is cancelled. Really simply explained. As I said, in CFDs, the same is happening, but in futures, you need to do this yourself. Most of the time, the broker is not doing it. So we have the same type of orders we already went through, but maybe a good repetition. We have a buy limit, we have a buy stop and sell stop, of course, and we have a buy stop limit and a sell stop limit. I think we don't need to repeat this again. If you want to repeat it again, skip to the earlier part in this course. In futures, we also have MOC orders. So a MOC order is a market on close order, which is where a position will be closed at the best price. The market will present a counterparty slightly before or during or slightly after the end of the trading session. So back in the days, there have been trading pits where people ran around the stock exchanges and traded. Nowadays, it tends that markets are open nearly 24/5. Maybe in the future they will be open 24/7 like cryptocurrencies, but for now they are not. They have a session where they are not opened, and they have a cash session where there is the most volume depending on the underlying asset, depending on the asset is in Europe or the asset is in the US, but most of the time, local times in Europe or in the US, the products are traded in Europe between 8 or 9 a.m. until 5 in the afternoon. Same as for US. Of course, you need to calculate the time of the asset you trade to your time zone, but there is no universal rule we can give you, but you will always focus on the local times of the stock exchange and where is the highest volume. We'll go deeper into that, and you will also see in the charts below where the most volume is traded. That's when the cash session is, and at some point the cash session of especially future products or future contracts, the cash session is over, and then you get the best price at the end. You see at the closing session there is a spike in volume because there's like the settlement of open positions. Day trader want to get out of the markets because they don't want to have exposure through the night, and also big institutions which had a very big order they needed to place in the market, they try to sell or buy depending on the order they get at the last session. So there's a lot of action at the end, but you can also choose an MOC order, which is the best price at the closing auction. And that most of the time you don't have in CFDs because a lot of them are traded 24/7, 24/5, I think. So what is the checklist for good futures broker? We had the same with CFDs. Now we do it for futures. First, you need low commissions. It's just about how much commission do you pay to trade one contract, to open it, to close it. What are the margin requirements? Also different on different brokers. For example, when you hold stocks, when you have Apple stocks, which are highly liquid, are they able to be calculated as part of your margin, or do you really need cash in your account that it needs margin? It depends on where your broker is. Even Interactive Brokers, it's not the same worldwide. It depends on if you're Interactive Brokers US, Interactive Brokers Europe, Interactive Brokers India. So it depends on where you are located, but the margin requirements, the lower they are, the better, of course, because you need to have less money on your broker. Then how's the capital insurance? So if the broker goes bust, Is there an insurance? Is the government behind it? Is there another insurance that your money is safe? And again, how's the review? How's the reputation? How's the history? Is it a new one? Or will it pay out if you earn money? So if you have a broker, if you got an ad of a broker or heard of a friend, just choose that one. We are mainly using Interactive Brokers for trading, but there are several good brokers. So there is not the one that we are affiliated with. It's just the one we currently mainly use, but there are, as I said, a lot of good brokers. Then you need a data feed because it's centralized, not decentralized, and you have real volume, so you need a data feed. So if you want to access the order flow data, which is the information, how many contracts are bought and sold on which price level, you need to buy a data feed. And there are also different providers, but this data feed provides you access to the real transaction that happened on this centralized exchange with this asset, which is very valuable information. And most likely your broker is not able to provide it. Depending on the assets you trade, most likely you have a broker and then you have a data feed provider and you need to connect them. Depending on the source you have, I think TradingView does not yet provide data feeds, but I think in the future they will. Maybe nowadays they already do. But for example, Sierra Chart is a software we use a very long time, but kind of complicated software. But there you have the platform, which is called Sierra Chart. Then you need to choose a broker. Either it's Interactive Brokers, it's the one we use, but there are different ones you can connect. And then furthermore, you have a data feed where you get your data from, so that's a third provider. But you need to choose it depending on the assets you trade and depending on the accessibility your software gives you, or APIs, or things you connect or can connect. There are different exchanges and there are different contracts. We will list some examples here. So we have the CME, Chicago Mercantile Exchange. There you can trade futures contracts, for example, the ES, which is the S&P 500, or the underlying asset is the S&P 500. You have the NQ, which is the NASDAQ, and you have the RTY, which is the Russell. For example, the CBOT, where you can trade government bonds. You have YM, ZT, or UB. You can trade on the COMEX. You have GC, which is gold, MGC, which is a micro contract of gold, silver, and so on. And on the NYMEX, you can trade CL, which is oil, MCL, which again is the micro contract, or NG, which is natural gas. But there are more contracts or assets you can trade. But you see that there are different exchanges, which are the centralized exchanges for future products. What types of data feeds are there? So there's level 1 data. So top of the book, you just see the first 10 bid and the first 10 ask level. So the prices people want to sell, the prices people want to buy. This is very good if you only use footprints, or you just use footprints and you don't use the order book a lot, because then you see the first 10 bid and ask levels. Level 2 data is the full market depth. So you see all the bid and all the ask levels that are available on that exchange. So even if you have 200 ticks above, you can see how many sell limits there are. It's good if you want to use heat maps or you use the order book for your trading itself. And then there is level 3 data, which is market by order, which shows you even the details where the order is coming from. So for example, you have iceberg orders. Iceberg orders are orders where you only see 20 contracts in the order book. But when there is somebody bought or sold those 20 contracts, there are another 20, but it happens so fast that you don't see it. And with level 3 data or MBO data, you can spot those icebergs or stop runs. Currently, the only provider that offers this is Rithmic to retails. Of course, institutions have other options, but we are not institutional. We are retail, but that's the logic behind that. So you see where the orders are coming from.